Hi everyone, this is Paul back with my video series, Darn Good Advice. Today's Darn Good Advice addresses the principles behind age-based asset allocation, which is a really fancy way of saying, where do I put my money when I'm young? Where do I put my money as I'm approaching retirement? Where do I keep my money now that I'm retired? So this is a very complex question. There are many, many resources out there of information, and everyone has a different perspective and opinion. Today you get mine. Some, such as Dave Ramsey, says stay invested in the stock market. The stock market returns on average, no guarantees, 10% a year. So you can spend 10% of whatever your retirement nest egg is every year because new market gains will replenish what you have spent. Starting in the 1990s, there was a much more conservative approach called the 4% rule. This has actually become the de facto standard throughout the industry, and we're going to expand on this quite a bit throughout this video. I am using a combination of the two as my go-to solution, and I'll explain why so that it all makes sense to you by the time we get to the end of this video. So what is it that we're actually managing here? What we're managing is fear. Fear that I won't have enough to retire. Fear that I won't have enough money throughout retirement. Fear that I won't be able to live a comfortable life while retired. People want to know that all their years of hard work is going to pay off. And to do that, it really boils down to a simple 5-step plan. I'll lay it out here for you very briefly. Number one is grow as much money as you can while you're working. Then, as we start to approach retirement, we're going to go ahead and move out of the crazy up and down and up and down and up and down volatility of the stock market into things that are more stable and more predictable to make sure that we don't lose our money in the years when we actually need it. Then we will make sure that we're accounting for the losses of inflation and plan to live off of our earnings forever. Now, your plan may include some degree of spending down your nest egg, hopefully running out of money the same day you run out of breath and God the Father calls you home. That's the ideal world. And just remember that anything else, Social Security or pension plans, etc., that is just extra gravy on top goodness. So let's take a look at what the wise old sage has told us and what has become the de facto standard in the industry. And I've alluded to it already. We grow in the stock market, growth oriented investments while we're young. Why do I emphasize young? Well, the real answer is while we have the risk tolerance, because we don't care if the stock market goes down 20% tomorrow. We're 5, 10, 20 years away from retiring. We're very confident that the market will recover before I hit retirement. But there might be somebody retiring today, and a 20% downturn may make the difference as to whether or not they can retire or not. And they don't have the stomach or the funds to know that they're going to be okay in time because that's not guaranteed. So there is a migration from the volatile stocks to more predictable returns, such as dividends, bonds, dividend paying stocks, municipal bonds, CDs. There's many things out there that can guarantee a rate of return. So we accept that the very first thing we need to do is grow enough of an investment nest egg for retirement as possible. Now, for this example, I'm using $4,000 a year as IRA contributions because that is the national average that Americans are putting into their IRA. The IRS allows us to put in $7,500, and that number generally increases by $500 a year to account for inflation. So depending on what year you're watching this video after I make it, time travel, then these limits may be even higher. But for this example, I'm using and staying with $4,000 a year because the average person in America can come up with that. And if they can do it, at least you can do it, right? There's no reason to not be a millionaire in America if the average person can put away 4 grand. So let's take a look at this chart comparing two people who put in $4,000 a year. One invests in something safe like bonds or CDs, etc., at a 5% return versus the same person who puts away $4,000 a year, but they ride the wave of the average 10-year return in the S&P 500 stock index. Now understand that the equation for compound interest is exponential. Every year you're getting interest on all the previous year's interest. So year number one, year number two, year number three, it's interest on your interest on your interest, and it only gets bigger in those outlying years. Now, what I show in this graph, $4,000 a year, starting the graph at year number 20, because that's when we start to see these diverging lines of exponential growth. So what we see here is that even though you're earning twice as much or half as much as the other guy, it's not long that you're linearly equated to each other. Meaning, take a look at the first line. Year number 20 at a 5% return versus a 10% return, it's almost twice as much. But take a look when we start getting to year number 30. Now it's 3 times the difference. And it's not long at year number 40 that it's almost 4 times the difference. And it just keeps getting bigger. You are hitting millions and millions of dollars. This happens to be why Dave Ramsey adopts this as his approach. If you're riding that blue line and you get to age 65 and your blue line is so far above people who were getting 5% returns, then certainly you can start spending 10% a year, keeping up with the market. Even if the market adjusts by 20%, you're still way up there on the blue graph, right? So while many people think that 10% Dave Ramsey is far too aggressive, the reality is as big as that line's going to be, he's probably not too far away from having a very realistic approach. But let's take a look at what it is that the average market advisor is telling people to do, and that is to get away from market volatility. Here's the exact same growth line as before, and we see that what we want is that warm, happy feeling of when we see our maximum top value of our investment account. What we don't want is when that market corrects down 20%, right? So again, we're mitigating the fears. So is there a way to lock in these gains when they're up and avoid the downs? So we call that the migration years. The exact same graph, and now we start to approach retirement years. We're stepping away from the comfort of knowing that we have plenty of time to let the market correct in our 20s, in our 30s, in our 40s. But when we start hitting our mid 50s, maybe approaching our 60s, where we might start thinking about retirement, that's when we want to take the luxury of time and wait for the market to be up, and then we lock in those profits by shifting out of the riskier investments and moving into the more stable fixed income investments that will take us from a 10% return probably down to a 4 or 5% return, because we don't know what the future holds, right? And the last time I checked, Amazon does not sell functioning crystal balls, right? So if you want to lock in those profits as you're approaching retirement, you have the luxury of time to do that. So that is the foundation of the 4% rule, right? You've grown this pot of money. You're now going to invest it in fixed income investments that generate 4% a year. And it's that 4% a year that we count as our retirement income. Woohoo! But we forgot one aspect. Don't! And that is inflation. Remember when Grandma said she used to buy a gallon of milk for a quarter? Well, Grandma has the exact same quarter today, except now it costs 8 quarters to buy a gallon of milk. So the quarter didn't change and the milk didn't change. You just need more quarters to get the same amount of milk. She's lost buying power in her money. That is what inflation is. So if you're a saver and you're saving money in the bank, I guarantee you're losing money every year. Your balance isn't going down, but your purchasing power does. You need more of those dollars to buy the same stuff as today. So what is that number? How do we quantify it? Well, we take a look historically. Now, we did have some 40-year high crazy record inflation under the previous presidential administration, but that was an anomaly. On average, the rate of inflation that you should expect and plan for is about 3%. So I do my math at 3.5. That gives me a little extra cushion. So with a 3.5% inflation rate, what does that mean I should do? It's interesting information, but what does it really mean to me? Well, it means that now we know what number we have to play with in order to stay ahead of inflation and not let it catch up and eat us, right? So some portion of our retirement must stay in the stock market so that we can stay ahead of the erosion in purchasing power caused by inflation. But how much? All right, let's do the math. Believe it or not, the math's not that hard. It gets no respect. I gotta love my Rodney. So I choose $100 as an example. A lot like 100%. That should make this NG easy, interesting, right? All right, so if I lose 3.5% of my $100 to inflation, it means I've taken a $3.50 loss in buying power. Your mission, should you choose to accept it, is to create a way to recover that $3.50 loss. Let's get into it. $3.50 back in the market, the same market that averages a 10% return, means out of my $100, $35 needs to be sitting in the stock market. $35 out of $100 is 35%. So let's take the next step, shall we? The modified 4% rule says we take our retirement pot of gold. We put 35% of it in growth oriented investments, netting 10%-ish every year. That money goes back into the pot, which we are now able to invest in our fixed income, generating that 4% gain, keeping up with inflation, and generating that income that we need forever. Woohoo! That's what works for us, right? This is the blend of a growth and an income approach to asset allocation based upon age. So what is missing from this video? Well, lots of stuff. As I started out saying, this is a very complex issue, and estate planning and retirement planning has many, many facets to be considered, or else I'd be making a 3-hour video. What I did was showed you two perspectives, the 10% rule and the Dave Ramsey approach against the 4% rule, the more conservative de facto standard approach. We did no accounting for taxes. We did no mention of Social Security per se, no planning for Social Security or Social Security calculations, or considering estate planning, which means also considering our Roth versus our traditional, which one counts as income as far as adding to my taxability for Social Security, et cetera, et cetera. So there's many facets not addressed here. But the general rule, the general concept of moving your asset allocation based upon your age to mitigate risk was exactly what I was going for. And I think I hit it pretty good in this video. Folks, please like and subscribe to this darn good advice of age-based asset allocation and all of my other videos. You can see some of them here. There's my hand. Some of them here. Like and subscribe. Leave some comments. I'll make a video on whatever it is you have questions about. And I hope this was short enough, yet interesting enough to be of value to you and you watched it to the end. I'll see you in the next video.